Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is June 17th, 2021. We have three topics to discuss. We're paying attention to your Blanke Schein Wealth Management, so you should be too, and hopefully you learn a little something, so thanks for staying with us. Yesterday we had the Federal Reserve Chairman, Jerome Powell, discuss in his press conference of the FOMC meeting. Post that meeting, he basically indicated sort of a picture preview of how the Fed is thinking about the economy on a go-forward basis. And he actually used the talking about and removing that language. If you were with me earlier Tuesday, I said tomorrow and that Tuesday video update is going to be the meeting Wednesday. And yes, it was, because the markets dropped as a result, on the S&P, Dow, and NASDAQ, as well as today as I'm filming this. NASDAQ is up, but the Dow and S&P are down. And very specifically, it's a result of interest rates. So I was talking about the danger zone. Go back if you haven't. Watch my video a few days ago. And I really set this up, and it really played out as exactly how we set it up here at Blanke Schein Wealth Management. We talked about the range for the 10-year Treasury. And the 10-year Treasury, quite simply, is in a range from basically the 147 mark to the 174 mark, high to low. We call it a trading range right now. And so if it stays within, then the market will sort of stabilize on a go-forward basis, because as interest rates come down, the future earnings potential, or the discount to cash flows for growth companies, think large cap growth, actually rise. And that's why we saw the NASDAQ go up today, because what happened is the 10-year Treasury yield came down. It spiked yesterday as just after the press conference with Jerome Powell was talking. And so what was interesting is it actually went up and down in that range, full circle, 2 turns, top to bottom, and it stayed within that range within the last 48 hours, which is absolutely exciting, because from a trader's perspective, from a charts perspective, from an economist's perspective, to have something sort of play out as if you predicted it, doesn't happen all the time. But when it does, it's kind of really exciting to show sort of the handle on what we expect and what actually came out as a result. So he was super dovish in the press conference, and he ultimately said that they are open to the discussion on the quantitative easing tapering, and I'll talk about that in a second. But the U.S. still has substantial further progress to make, and he's specifically talking about he's not worried about inflation, so meaning rising interest rates to combat inflation. He's talking about full employment, which is the other mandate. That's a dual mandate by the Federal Reserve. So inflationary pressures they have to stay on top of, as well as full employment. That's their dual mandate. So if they are looking at full employment, he said there's substantial progress still needs to be made as it relates to supporting, by way of quantitative easing, that's the bond purchase of $120 billion per month, and low interest rates. What does that mean, Rob? How do we go? Where do we go from here? Ultimately, we did find out that the Federal Reserve Chairman, Jerome Powell, is a straight shooter. He has been, and he still will continue to be. As people try to interpret what he means and what he doesn't say, it actually, yesterday we learned he shoots from the hip. And what he said is, I'm going to maintain and stay focused on making certain the economy is well in hand and well off of its lows from the economic downturn from the pandemic, as well as every socioeconomic level across the United States is fully, if you want a job, you can get a job. That's the bottom line. And so we're going to see that play out. And then he'll have the conversation, which he opened it up on a go-forward basis as to when they should raise interest rates. I reported last Tuesday that their forecast was 2023. He reiterated, somewhere in that range. I mean, obviously, if the market overheats and the economy overheats, he could change that at any given day on a go-forward basis. But that's where we are right now as it relates to the Federal Reserve. Now, one thing they did say is, my advice to everyone, which is another one of my topics today, which is lock in your mortgage rates. Now is the time to refinance, and I would not wait, because what they also indicated is when they have quantitative easing and they start basically unwinding that, they are right now spending a portion of that $120 billion in the mortgage-backed security marketplace, which means they're just buying all those mortgages that are being refied and or new purchases, right? We know housing is super hot right now, and who's buying some of those mortgages? Well, the Federal Reserve is doing that at a feverish pace in terms of their quantitative easing or what they're doing to support the market. When they buy, that means it's suppressing or keeping mortgage rates at 30-year fixed down. Now, what's the first thing they said they indicated that they might take away is that the mortgage market bond purchases. And if they do that, they're going to naturalize and equalize the marketplace. And that means that the 30-year, they're going to reduce their purchases of the mortgage-backed securities. That's the first thing they're going to do. And when they do that, the cause and effect is mortgage rates will rise. And that's one way for them to normalize and slow down the pace of housing by increasing the interest rates, which means your affordability factor comes down. And so that could temper housing later on. We're thinking post-Labor Day is when the Federal Reserve might be indicating or actually proactively doing something like this. So take-home point, what do you do in this moment in time? If you haven't refied or if you haven't made that purchase just yet, now is the time to do it. We can look back after I film this and months later and see if we're spot on this, but I think history will be on our side, and I'm curious to see what happens. But right now, don't mess around. Refinance your mortgage. That's the best way to go about it. And then the final topic we're going to talk about is the global growth. Now think about it. The United States, we have a good 60+% vaccination across certain age groups that are affected, the older age groups, if you will. I think 70 plus is 70 plus in terms of vaccinations. And that's really helpful as it relates to the economy is going forward. But globally speaking, like China and the UK, there's fits and starts. There are some outbreaks and some viruses that are, that are hitting us or hitting the global world right now. So the leading economic indicators, the LEI, are what we look at as we look at here at the investment committee on a go-forward basis at Blanke Schein Wealth Management to show us how global growth is lining up. There are some great growth there, but it's not like the United States. So we're clearly out of the gate with a lead right now. And we are not going to lap anybody for any stretch of the imagination, because remember, globally speaking, we're all interconnected. So there's some supply constraints that we're getting from cars to, obviously automobiles to chips and computers, right? So that comes from outside the United States for the most part. So as they have hit with sort of second flare-ups of some viruses from time to time, around the globe, that's where we're going to see those fits and starts. So globally speaking, we're all interconnected, but there is a delay on their side as it relates to the growth that they're going to see relative to the growth that we're going to see. That being said, that doesn't mean we're not believers of global equities. In fact, there's some great opportunities there, and we're taking a look, as we always do here at Blanke Schein Wealth Management. And one final take-home point, if one thing is for certain, that's why we have a proactive approach here. In the last couple of days, you see the volatility in the market. We see it's going to persist in the next couple of weeks. Usually does, seasonally does, the first 2 weeks before, or the last 2 weeks of June. Last 22 sort of years, it has actually increased volatility, and it's just a seasonal sort of slowdown and sort of retracement or reset, rebalancing, if you will, of the markets. So last 22 years, we've seen sort of a sell-off opportunity, sell-off meaning a buying opportunity for our clients, and we have cash. We have cash on the sidelines, as we always do, to take advantage of that. And then right after 4th of July, we see a rebound. We can't predict it on a go-forward basis, but history is our guide, so we'll use it. And we'll see how it plays out. But on a go-forward basis, next couple of weeks, it would not be uncommon, based upon looking at history, that we will have some more volatility ahead, as I stated that last Tuesday as well, and we just saw it in the last 48 hours play out. So we're well positioned. We like what we see. The backdrop is a solid economy. The backdrop is more stimulus ahead, and companies are making money. And it looks like interest rates are kind of they're in the right zone, not the danger zone. The danger zone would be above the 174, as I said on Tuesday. That's the number we have to look at. And so I think we're good. So thank you for watching today on Blanke Schein Wealth Management updates. And I hope you learned something. And also want to give you an insight as to what we're watching, what we're paying attention to, and what we think about as we manage our clients' portfolios on a go-forward basis. Take care. Have a great day.